Moving swiftly on, using the term swiftly very loosely. Okay, we're going to start the Dean paid credit. Welcome back. Sorry. No problem. We're going to start the Dean paid credit. And the first obvious question is, why do we need a Dean paid credit? And you'll see down here where we're coming up with three situations which will then show on a chart. And I want to indicate what the three situations are. The first one is, of course, where you have a U.S. company which operates, let's say, through a branch in another country. The second one is where it operates through a subsidiary, yes, and we are assuming for purposes of illustration that there is no deemed paid credit, so no Section 902. So pretend there is no Section 902 in the code. And the third is the same as the second, but with 902. Now, those are our three. The first one, branch. The second one, with a subsidiary, but pretending there's no indirect tax credit, no 902 credit. And the third one, which is with a 902 credit. Now, notice as we look back at our pictures, if we have, I think we said 100 or 1,000 of revenue, we have 900 of expenses, we have 100 of net income, and since the branch is in fact a branch of a U.S. company, the U.S. company itself is the taxpayer, and as a result, when we look at this, we see, okay, the revenue, the expenses, and that net income is taxable by two countries. First, country B, we said there's a 20% tax on the net income, and we're saying there's a 10% profit remittance tax. So that the total is 28. The 10% profit remittance tax, the basis for that tax is the after-tax earnings of the branch. So 100 of net income minus 20 of tax gives 80. 80 times 10% is 8. So the 20 plus the 8 is 28. That's where that comes from. Some number of countries have this kind of thing, which is often called a branch profits remittance tax. Some do, some don't. Does the U.S. have such a tax? Okay, Shane, I see you going like this.
Yes.
Yes, okay, what is it? Okay, I'm sorry. I was just thinking, where do you find it? Anybody remember?
50%.
Yeah, 30%. And, I mean, that results in a rather high tax. Okay, so the U.S. has this. A number of other countries have it. So I'm using it as part of the example. And because we said that, of course, it's taxable by two countries, country B and the U.S., the U.S. tax is going to be 35% times the 100, which is the taxable income. And we will assume that there's a foreign tax credit limitation of 35. Again, we'll talk more about the foreign tax credit limitation later. But we see that there's 35 as the limitation. But since we only pay 28, 28 is the amount of credit. And 28 from 35 gives 7, so we have a U.S. tax payable of 7. And our total tax obligation is 35. 7 to the U.S. government, 28 to country B. Now, what happens if the U.S. company, says, well, gee, there are good legal and business reasons regarding why I should operate in subsidiary form rather than in branch form. I have real important reasons to do that. So what happens if the U.S. company does that and there is no deemed paid credit mechanism? That's what we're looking at now. Okay, the country B tax will now be on the subsidiary, legally on the subsidiary, and it's 20. There's 100 of income inside the subsidiary. There's 20 of tax, and then we assume a dividend is paid of the 80. We assume a dividend is paid of the 80. There's a 10% withholding tax on the dividend in order to make it equivalent to that 10% branch profits remittance tax in the first column. And our total country B tax is 28. 20 is a tax that is on the subsidiary. 8 is a tax which is on the U.S. company. So the 8 is a direct tax. It's a 901 tax. And if there's no Section 902 in the code, then the 20 of tax paid at the subsidiary level is lost. If no 902 deemed paid credit, the tax at the subsidiary level as a credit is lost. So that means when the dividend is paid, when we calculate our U.S. tax, the dividend is 80. 80 times 35% is 28. So the U.S. tax before any foreign tax credit is 28. How much foreign tax credit can be allowed? Well, only 8 was paid by the U.S. company. So 8 is allowed as a credit, leaving 20 of payment to the U.S. government. So now if we add up and say what was the total amount paid to all governments, we end up with a total, in a sense, economically, 28 paid to country B, although partly paid by the subsidiary, partly paid by the U.S. Shareholder, and then another 20 payable to the U.S. And that, of course, adds up to 48, which is a terrible answer. And because it's a terrible answer, if we did not have Section 902, most U.S. companies would operate overseas as branches. they would choose not to use subsidiaries. Now, I think at some point, maybe during the first class session, I said that one goal of the U.S. is, the U.S. Congress in a sense, is neutrality. They don't want you to make business decisions based on tax-motivated reasons. They want you to be free to decide on the branch or subsidiary decision based on good legal and business reasons, not based on tax reasons. So the deemed paid tax credit, 902, is there specifically to allow this to happen. So if we now look at our third column, which is the same as the second except with the deemed paid credit, we see that, of course, country B taxes are the same. The 20 is on the subsidiary. The 8 is a direct tax on the U.S. shareholder. When we calculate the U.S. tax, we do two things. We take the dividend of 80, we add to that 80 the amount of the deemed paid taxes of 20. That's your Section 78 gross up. You add those together and you get 100, which of course puts you economically back at the 100 of income that was really earned. You then calculate your 35. You calculate your foreign tax credit limitation. You say, my 28 of foreign taxes paid, which is the deemed paid of 20 and the 8 directly paid. That gives us 28 of foreign tax credit allowed, which is less than the limitation. That means we need to pay 7 more to the U.S. government. And it gives us an answer which is the same as if we had done business in branch form. This is why you have a deemed paid credit. Any questions about this? Because the point is, why is 902 there? It's there to equate a branch operation with a subsidiary operation from a tax viewpoint. That's the theory. Does it work out that way exactly in practice? Well, maybe not. Sometimes, of course, it will. Sometimes it won't. But this is why it's there, and it's, I think, very important to understand that as background. Okay, when is 902 relevant? Well, the example we've talked about, the one we just talked about, where in the or let's say the third column, there was a dividend. There was an actual dividend being paid. So 902 is applicable when there's an actual dividend. But you, of course, can also have dividends in a lot of other situations within the code. You have a redemption, which is treated as a dividend. You have a number of things in the international area where there is some sort of a constructive dividend or inclusion in income because of something that's happened down at the subsidiary level. So you get this deemed paid tax computation in a number of situations. Anytime there is, in theory, a distribution of earnings and profits, and notice I'm saying earnings and profits rather than taxable income. you have this computation to make. And this is a benefit for the taxpayer. This is costing the government money. Now, this is a rather important point, that this is a taxpayer benefit. Therefore, the rules are not expansive. The rules, as we get into some of them, will be more focused. And if you're outside those rules, then you're not going to get the benefit. You know, it's sort of like, you know, if you think about the code generally, it defines income as absolutely everything that you could ever think of or even not think of. But deductions are only allowed to the extent they are stated to be deductions. Well, it's the same thing here. This is a benefit. You have to qualify for it. If you don't, you're out in the cold. Looking at an example of how one might be out in the cold. There are some rules. You'll read them in essentially 902B, which look at whether a company is whether a domestic shareholder, and that domestic shareholder again is a corporate shareholder, not an individual, whether that corporate shareholder owns enough of the foreign company which is paying the dividend, for example. Okay, so notice that again, S corporations and individuals cannot obtain any benefits from this. And there's a basic rule that the first tier company, you have to own at least 10% of it. You have to own 10%. If you own 9.99, not enough. There's a bright line cutoff. And notice no constructive ownership rules. You know, if your mother-in-law owns some of the shares, that doesn't help you. There's no constructive ownership through other entities. You've got to own at least 10% directly. Now that's for the first tier. Notice over here, this one, in a sense, is a second tier. The 5% is not enough. The domestic shareholder may own economically 40%, but since there's no constructive ownership rules, the 5% is not enough. There will be no deemed paid credit with regard to dividends that go directly under that 5%. Whereas, at least to the extent that it's paid to the CFC, then it could be. We won't go through this. We'll just give some examples. I suggest that you, again, read through these things and then look at some of the regulation sections and code sections to see it in a little bit more detail. But just to look through an example or two to get a sense of it. Under these rules, you have your domestic shareholder, which is again a corporation. Tier 1, Tier 2, Tier 3 can be any corporation. Does not have to be a controlled foreign corporation as defined in the Subpart F rules, which we'll get to later. You just have to meet the ownership tests, which are each ownership line is at least 10% direct. And then the total, if you add up if you multiply the ownership percentages, and I'll show you an example in a moment for that, it has to be at least 5%. Now, these are just arbitrary rules. I'll say a little bit more about that later, but just understand you can go down no lower than 6 tiers. And the bottom 3 tiers must be controlled foreign corporations as defined under the subpart F rules. Arbitrary rules. Don't worry about memorizing them. Just know where to look for them. Okay, so as a specific example, domestic shareholder owns 10% of a Tier 1 corporation. The 10% test is met for that Tier 1 corporation. You look at the second tier. We say that Tier 1 corporation owns 50% of Tier 2. Okay, 50 times 10 gives you 5%. So for Tier 2, both the 10% direct test is met. Tier 1 owns 10% or more of Tier 2. And the 5% test is met because when you multiply these out, the domestic shareholder does own indirectly 5% or more of this one, of the Tier 2. And when we get to the third tier, where we're saying it's 90%, the 10% test is met, but the 5% test is failed. And again, why are we looking at this? Because the Tier 3 corporation, the Tier 2 corporation, and the Tier 1 corporation are presumably in their countries of incorporation and operation conducting activities and paying income taxes in those countries. Each one may at some point in the future make a distribution, which is a dividend, to the next tier up. And the question is, will income taxes that each tier pays, ultimately when that dividend gets to the domestic shareholder, will those taxes be allowed as credits, deemed paid tax credits, at the domestic shareholder level? That's what we're trying to get at. And because the Tier 3 corporation in this specific situation fails, then that means that any income taxes it pays will never give benefit to the domestic shareholder. Never. I said that the 10% and the 5% rules are arbitrary. They are. They're very arbitrary. When the law was passed, they said, gee, 10% on this one, 5% on this one, and that's life. I think it's a combination of simplification, creating a bright line test, and in a sense, Congress's way of trying to distinguish between what you might call a portfolio investment, which is made by somebody who is not active or able to influence management, versus an investor who perhaps has a seat on the board of directors or somehow influences the business. So it's a very bright line test, and it's just there. we'll go through a couple of slides to look at this formula. This is, how we calculate the deemed paid tax credit. And what you want to do is think about a few conceptual things rather than the formula itself. Okay, notice we talked about earnings and profits, of course, before. So the denominator up here in this formula is earnings and profits. Okay. And we know that, and we'll assume for simplicity that an actual dividend is being paid as opposed to a constructive dividend or something else. We know that a dividend is, again, something that is a legally identifiable thing. You look at documents and you see how much a company distributes out of its earnings, and that dividend is what goes up in the numerator. So what we're doing is we're saying how much of the earnings have been distributed. Could be that all of the earnings from a particular year have been distributed, or maybe just part. Maybe some of the earnings have been retained in the subsidiary. So this is just getting a percentage of how much of the earnings have been distributed to the shareholder. Okay, now, once we determine that percentage, we say, okay, well, how much foreign income taxes were paid that relate to that earnings and profits? So it's a simple proportion. If half of the earnings and profits have been distributed, I think the next slide shows that. If the dividend received is 50 and there's earnings and profits of 100, then half of the earnings and profits have been received, and we say, okay, well, if the foreign income taxes are 30 that relate to that 100, then that must mean that the deemed paid tax is 15. So just a simple proportion. And the U.S. shareholder at the top of the chain will show the 50 of dividend as income and have the Section 78 gross up of 15, and he'll show taxable income of 65. So the calculation, this calculation is quite simple. Now, there's a few things to try to get at in regard to this. First of all, notice that it says post-86 income taxes, post-86 undistributed earnings and profits. There are pools that are set up for all years from 1987 through the present. Now, there are some exceptions, but we'll forget about that for a moment. Why would you, well, what's the alternative to a pool? Anybody remember from your corporate course whether your calculation of earnings and profits and how you do that is a year-by-year thing or is a cumulative thing? Or anybody remember? Okay, first out of current and then out of accumulated. And you find that presumably in what, Section 316, which defines a dividend. Okay. In the domestic context, you don't care about deemed paid tax credits. It's just not an issue. So having, in a sense, first the current year and then everything, up through the prior year as, in a sense, two pools, makes sense. In the foreign context, up until 1987, it was a year-by-year calculation. So that this was not post-86. It was 1986, or 1985, or 1984, or 1983, or going back, presumably, to 1913. It was year by year. Now, why does that make a difference? Well, let's keep that in mind as to why we're thinking about this, and then let's go to the next slide or two. Notice here we've changed the numbers slightly. We've said that earnings and profits is 2, and the dividend received was 1. So we're still saying 50%. But we're saying that the foreign taxes are 30. Gee, how could that happen? How could the tax be so high? Well, you remember what we talked about in the amortization of the patent costs? Remember that? Well, that's one way it could happen. There's many, many ways it could happen, because there could be very, very big differences between foreign calculation of net income and U.S. calculations. Has anybody ever heard of the completed contract method of accounting, or the percentage of completion accounting method for long-term contracts? Does that ring any bells? Well, the question, for example, is whether you, let's say you have a contract to build a dam and it's going to take 5 years. Do you anticipate approximately how much profit there's going to be and then recognize, let's say roughly 20% in each of those 5 years? Or do you wait until the end, the last day, when you have all the income and deductions and calculate net income then? Well, percentage of completion is that 20, 20, 20. And completed contract is recognize the income when the contract is completed. Well, if you have the foreign country accounting one way and the U.S. accounting of E&P another way, you can have some pretty major differences. So this was not unusual that this kind of thing could happen. Now let's hit the next slide. And in this example, we have, for earnings and profits purposes, a loss. But for foreign purposes, there was income and there's still that same 30 of tax. Well, I don't know about about how they teach mathematics today, but when I, took an arithmetic course, I think they said that division by 0 was impossible, and as a result, irrespective of the mathematics, we end up with 0 tax paid for we end up with a 0 for the deemed paid tax. So if we have no earnings and profits, we cannot have a dividend under Section 301. And because we have no dividend, we have no deemed paid credit. So this is another one of those terrible answers. Okay, so year by year versus a pool. Let's think about it considering these last couple of slides. Let's first go to the back to the previous slide, where there was earnings and profits of 2, we distributed 1, and that dividend of 1 brought with it a deemed paid credit of 15. So for U.S. tax purposes, we had 16 of income, the Section 78 gross up of 15, 1 of dividend, U.S. tax of 35% of 16, 5.6. Because the available foreign taxes are 15, we end up with 9.4 of excess foreign tax credit, which is available for use against other income, which is low taxed, other foreign source income, which is low taxed. So think about it. Maybe, if you're a little sneaky about it, maybe, when you're doing your local tax computations, you choose to take deductions in certain years or accelerate income or do something to plan that every other year you'll be high taxed in the subsidiary and every other year low taxed. So 1 year high, 1 year low, 1 year high, 1 year low. And you say, gee, it's a year-by-year computation pre-1987. It's a 1 year computation, year-by-year computation, so, gee, I'll only make actual distributions in the high tax years. In those years when it's relatively low tax in the subsidiary, no dividends. This was referred to, interestingly enough, as the rhythm method. So you maximize by only paying dividends in these years when you had high foreign tax and low earnings and profits, and you did not pay a dividend where there was low foreign tax and relatively high earnings and profits. Well, Congress looked at this and said, gee, it doesn't make sense to allow companies so much flexibility to manage their foreign tax credits. Because companies were very scientific about this. So they said, let's cut off at 1986, start fresh 1987, it's now a pool. It's now a pool. And as a result, the rhythm method is no longer possible because you're always paying out of a pool which is going to average the results over the period from 1987 through the present. Okay, the second aspect gets back to our other slide. Think about this kind of situation happening where we have a year-by-year calculation. If it's a year-by-year calculation, there's no ability to adjust this later. That 30 is lost forever. It will never be a deemed paid credit because once the year's closed, it's closed. You cannot create earnings and profits in a prior year where it's just a year-by-year calculation. So this pooling approach was meant to be also a benefit to taxpayers who, whether through bad planning or whatever, ended up in this kind of situation where foreign tax credits were being lost. So those are the two reasons why we have this pooling approach that you find under 902.